EU ministers agree on a 180 euro megawatts per hour gas price cap. What do you think of that number?
I think that's a silly number for a bunch of politicians to do right at the edge of winter. We're now pricing in today at around 110 euros per megawatt hour. We see that easily doubling. Yeah, inventories have been high. It's one thing to have a price cap on, it's another thing to find out where the supply is coming from. So if we have we, in fact, have a magical change that's taken place in the global gas market. It is really global now. It's not bifurcated. It's not broken up into individual countries. It's not limited by destination restrictions in where LNG goes. Europe needs the LNG, and somebody's going to bid it well above that price if Europe puts that cap on and sticks to it. So it's almost a guarantee for blackouts rather than a guarantee for consumer content.
So, Ed, that's what I find so confusing. Like, longer-term contracts is one thing, but for the spot market, where does the liquidity go? Like, if you're a producer or a utility, like, how do you hedge? I mean, this still feels like a massive naked short now for the EU on gas prices. What are going to be some of the trickle-down effects from this?
Well, the trickle-down effects are going to be, political on the one hand. We have another big cold spell. We have a polar vortex, and we'll have that price going up not only higher than the price cap, but significantly higher. The price cap is sort of like the electricity price caps that are guaranteed already. If you have an electricity price cap, that doesn't guarantee that the natural gas is going to be there to provide for the need to the fuel for making electricity. So it's a significant bind, which will have repercussions politically as well as economically. And yes, it makes for a market that is not reflecting the underlying basis of supply and demand, and people take advantage of that one way or another.
Ed, there was a piece in the FT, I think it was Friday, I think I read it over the weekend though, talking about the fact that the ICE exchange was maybe talking about removing the TTF contract out of the Netherlands for the simple reason that managing risk in these contracts is going to be really difficult. You're going to go from having a contract at one price, potentially then it gets hit by the cap and it goes to another price, as a result of which utilities, traders are going to have to put up significantly more in terms of margin. Do you think that the politicians understand the market implications of what is happening here or what could happen here? Do you think they're doing this in isolation? Have you heard that they're taking advice on this?
I can't comment on whether they're taking advice on it. I can comment on ICE being correct, that the TTF is not reflective of market conditions. On the other hand, the TTF price is really the base price of global gas at the moment. It's the price off of which everything else is benchmarked. It's the ARB relationship between East Asia and Europe, which is based on TTF. It's the ARB relationship between the U.S. Gulf Coast and Europe. It's kind of the source of the basic price. So if we get rid of TTF and there's no liquidity for any other European benchmark, and there won't be kind of immediately, the implications are relative disorganization, chaos in terms of, what is the gas price, what's the real gas price, and what's going to move it from one place to another. Yeah,
that feels really solid. That's definitely what we want to see into 2023. And before I let you go, I just want to get your take on the demand portion of this whole conversation when it comes to oil, though. Or I guess you could say for gas. What does the China reopening story do to balances for the oil and the gas market?
We don't know yet because it depends in part on weather. But certainly if we see an increase in demand from China, say order of magnitude 1 million barrels a day for oil, the real question in the balance is what is that going to do to Chinese product exports? We had China before September 21 exporting about 1,200,000 barrels a day of products. When they went into the blackouts of September 21, they cut off all of their product exports. Those product exports at 1.2 million barrels a day, if they resume, if they get back to that level, then there is a balance in the market between the crude side and the refined product side that will make it less onerous for the market as a whole. So it really depends on other things, but in and of itself, that 1 million barrel a day increase in apparent demand shouldn't make much of a dent on the global product markets.